Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. All right, today, should you invest in international stocks? That is the question. It's really easy to be attracted to US stocks, especially after a long period of great performance. Over the past few years, the S&P 500 has posted really strong returns, significantly outpacing historical averages. That kind of momentum can lead many investors to ask, why should I invest outside the US? Additionally, the S&P 500, which is a US index, is arguably the most well-known index in the world. It's the one we always hear about, and it's the benchmark that news outlets like to highlight and sensationalize in the financial media. However, when we step back and look at the bigger picture, the case for international diversification gets a bit more clear and more compelling. So let's talk about recency bias and market momentum. As of late 2024, the US stock market has enjoyed a really strong run. Over the past 5 years, the S&P 500 returned an average of 14.5% per year, which is well above its historical average of around 10%. Much of that performance has been driven by a small group of tech giants, which we often refer to as the Magnificent Seven. And while that performance is pretty exciting, it can really skew perceptions. Strong US market returns trigger a common behavioral mistake: chasing recent performance and ignoring the long-term benefits of diversification. So what's the case for global diversification? Markets move in cycles, and the US is not immune to downturns. We've seen this before. For example, from the year 2000 to 2009, that's a period often referred to as the lost decade. During that period, the S&P 500 posted a negative return of approximately 0.9% annually. So negative 0.9% was the return. If you go back even further, 1965 to 1981, you'll find a 17-year stretch where U.S. stocks underperformed even treasury bills. These long stretches of underperformance highlight a fundamental truth about investing, which is this: past performance does not guarantee future results. Just because U.S. stocks have performed well recently doesn't mean they will continue to do so in the future. And that's where global diversification comes in. So global stocks are more than just foreign. It's important to remember that when you invest internationally, you're not buying countries, you're investing in companies. Global diversification gives you access to thousands of companies all over the world, and many of these are leaders in innovation, in manufacturing and technology, sectors like consumer goods. And these businesses are run by smart, driven people with the same goals as their US counterparts, which is to generate profits and create shareholder value. That's what companies want to do. And some of the most recognizable brands aren't even US based. For example, Budweiser is owned by a Belgian company. Trader Joe's is owned by a German company. As consumers, we already diversify international every day without even thinking about it. So why wouldn't we apply the same logic to our investments? What's the data show? Let's take a look at that. So in recent months, international stocks have actually outperformed US equities. Non-US developed markets have shown double-digit returns, and emerging markets have also posted solid gains. And this is not an anomaly. Historically, most countries, including the US, have experienced multi-year periods of underperformance. In fact, when you analyze over 40 countries, all but 7 have seen at least one 10-year period of negative returns in their equity markets. Investing in US stocks only is basically making a bet that the future is going to continue to look like the recent past. And we've seen before, that's not always a wise assumption. So what about US multinational companies? A common argument against global investing is, well, don't US companies already generate revenue from all over the world? These large cap companies, they have sources of revenue internationally already, right? So while that's true, many S&P 500 companies earn significant revenue abroad. That is true. The research does show, though, that a company's stock price tends to move more in line with its home country market rather than where it earns its revenue. So that means that US-based multinationals still behave more like US stocks, not truly diversified global assets. And just as the US has had global corporations, the US has global corporations, I should say, so does the rest of the world. Companies headquartered in Europe, Asia, and elsewhere also generating revenue globally and driving innovation. Let's take a look at an example. Let's learn from Japan's example. So one of the most powerful examples of the danger of home country bias is Japan. In 1990, Japanese stocks represented over 40% of the global equity market. So investors were convinced that Japan was the future. It was all about Japan. But over the next 3 decades, Japanese stocks were pretty much flat. And today, Japan makes up only 5% of the global market. So imagine if you were a Japanese investor in 1990, ignoring diversification because of recent strong performance. That risk of relying too heavily on what's working right now would have been an issue. Let's also take a look at small cap and value stocks around the world. Another advantage of global investing is the ability to diversify not only geographically, but also by market segment. Small cap and value stocks are often considered to have higher expected returns over time, but they don't always move in sync across regions. For example, in years when US small cap value stocks underperform, international small cap value stocks may outperform, helping to balance the portfolio and improve overall reliability of your outcome overall. Over the past 20 years, size and value premiums have remained positive in non-US developed and emerging markets, even when those factors lagged in the US. So ultimately, sticking to the plan is often a really sound approach. At the heart of successful investing is one basic truth, and that is the future is uncertain. You can't predict which country or market segment is going to lead over the next decade. But by owning a globally diversified portfolio, you give yourself the chance to benefit from the growth of companies wherever they're headquartered. When US markets are up, it's tempting to double down and really go all in. But history reminds us that strong periods are often followed by corrections or stretches of underperformance. Staying diversified is not about abandoning US stocks. It's still, ideally a large portion of your investments, but it's about building resilience into your portfolio. It's about accepting that surprises can be good and bad, but it's all part of investing. And it's about positioning yourself to get those future returns from wherever they might happen to come. So ultimately, diversification works across sectors, across asset classes, and across borders. So whether you're investing in like a startup in Silicon Valley, for example, a luxury goods firm in France, or a technology manufacturer in South Korea, you're participating in the global economy. And so if you limit your investments to a single country, no matter how successful they've been recently, you're ignoring a large portion of the world's opportunities. So next time you hear a headline that's declaring that, US stocks, no alternative, US stocks are where it's at, remember markets change and so do leaders. So a globally diversified portfolio is still the best defense and the best opportunity for long-term success because you are diversifying across all the possible opportunities globally. So keep that in mind next time you see something on the news that is highlighting the S&P 500 and you've got that home country recency bias factoring in. Keep in mind that diversification can build a lot of resilience into your investing plan. So with that, you're welcome to reach out anytime. My website is elevationfinancial.com. If you have questions about this or anything else, you can send me a note or you can book a free consultation if you want to consider working with me or just chat with me about whatever's on your mind one-on-one. All right, everyone. Thanks for joining me today. Have a great day. We will see you next time.